Certainly, it looks like investors are getting excited about these beats, although they are beating at depressed levels. Are we going to see a downturn here in terms of some of that downside risk for the market?
So I do think that we're fragile, but I think we were kind of ripe for a move in one direction or another. I said in my blog post this week, it's almost as if we've been stuck in this range. We're on a teeter totter that is stuck at perfectly horizontal. And any piece of news that was positive was going to send it up. A piece of news that was negative was going to send it down. So far, we've gotten decently positive news from not only some bank earnings, but the tech earnings and in some other little bright spots that we're finding. What could happen after the end of earnings season is if the economic data softens, that's where people are going to start looking at it and saying, okay, this recession that we've been waiting for, or this contraction in the economy that we've been waiting for, is now looking more like it's confirmed. And then you go back to the stock market and say, does that mean that stocks should be trading at 18.3 times forward earnings? The answer is probably not. It's not going to affect all sectors equally, in my opinion. I think if we do see an economic contraction this year, it affects those cyclical sectors much more strongly than it would affect big tech. And I think we're seeing a little bit of muscle memory of people going back into big tech and getting kind of excited and feeling like they're safe havens. But the last thing I would say on that front, especially in earnings season, is if you look at the sectors that are expected to contribute positively to earnings this quarter, it's mostly cyclical sectors plus consumer discretionary. If we have an economic contraction, those cyclical sectors are likely to take it on the chin a bit. So that would tell me that earnings expectations for the rest of 2023 might still be a little bit lofty.